Welcome to the Remarkable Retail Podcast, Season 6, Episode 8, presented by Market Dial. I'm Michael LeBlanc.
And I'm Steve Dennis.
Well, something different for the people on this episode, a solo episode on steroids. We're tackling a structural issue in contemporary retail by both referencing a similar period in retail history, and we're adding academic depth and clarity with one of our leading subject matter experts in customer financial metrics, and one of our most popular guests in the history of the show, Daniel McCarthy, Assistant Professor of Marketing at Emory University.
Yeah, it's great to get Dan back. And I think this episode, we've talked about all the things going on around these various digital disruptors in many episodes. But we haven't done a deep dive for a while. And with Wayfair's news and Warby Parker's earnings and some other things that are going on, I think it's a great time to talk about that a bit more and get somebody like Dan to help us unpack some of the facts.
Let's start with the big story. It's kind of earnings seasons, and the puts and takes on what it does to stock price aside. Any lessons that we're taking away for the prospects for 2023 based on the earnings that we're seeing coming out this week, Steve?
Yeah, I think the overall picture, and I'll briefly touch on a few particular situations, but I think the overall picture it's been pretty disappointing. Most retailers have been reporting either flat to down comp store sales, which of course is, one of the big metrics. And for the most part, the earnings are down. It's actually kind of interesting to me. You may remember on social media when people were talking about it being a great holiday season. I was kind of like, well, the sales look pretty good. I'm not sure the profits are going to be that good. Yeah. And as it's turning out, most of the retailers are not actually reporting very good earnings. And then the other thing that's been pretty consistent across the, 9, 10, 12 different retailers that reported in the past week was pretty much all of them guided, either guided down or said, this is a pretty uncertain environment and we're not sure exactly how things are going to play out, but it's probably not going to be particularly good.
All right, well, let's get into some of the actual specifics. So we saw Target, Kohl's, and Macy's with how do I describe the reaction to the Macy's results? It's kind of like Alice in Wonderland. But anyway, you can talk about that.
Yeah, just really quickly on Target. I mean, Target's more or less was a kind of a similar picture as Walmart, not quite as strong, but basically flat comp store sales. The earnings were down quite a lot, something like 43%. Brian Cornell basically described it as that they, going forward, look to be facing a very challenging environment. So, not super optimistic. They did, just as a quick aside, announce that they are going to be rolling out curbside returns. They've been doing quite a lot of curbside pickup, but now you'll be able to, just roll on up and do your return without having to go into the store, which I joked on social media. I love this. Just sort of tickles my curbside enthusiasm. So that was good. And
you can have your Starbucks with that too, right? Our guest Nancy King was telling us about all the things that were the top list of demands or requests, I should say, from customers that dealt with curbside. So I love the idea of returns to the curbside. It's fantastic.
Yeah, I think that's pretty interesting. But then we moved to the things that are a couple other companies that were definitely not so great. So Kohl's reported, and I also mentioned on social media that people were like, Kohl's had a surprise bad quarter. And I'm like, who thought there was not going to be a bad quarter?
Clearly not listening to this podcast.
Clearly, or just in general, paying attention to anything in retail. But yeah, it was pretty bad. Sales were down 7%, though they did say that Sephora, which they've been rolling out to, I think like 600 stores or something, was up 90%. And they've also quoted about how stores with Amazon returns are way up. So I'm like, well, if you add up all the business they're supposedly getting from Amazon returns and Sephora being up 90%, yet you're down 7% overall, I'm like, I'm not sure exactly what that says about the rest of the store, but probably not good things. But the thing that really, really hurt them, the sales decrease was bad enough, but their gross margin fell by 1,000 basis points. That obviously has a lot to do, which is why I thought it wasn't surprising at all. Their earnings were bad, but they were just loaded with inventory and marking it down like crazy. And so that really hurt them. And they basically said the outlook is not looking too great. I just also should mention that Michelle Gass, the prior CEO, has the best timing in the history of retail. She looks like a genius now for leaving. So anyway, but and then quickly, you alluded to this. I mean, Macy's reported and they beat expectations, which is always to me, I mean, I understand how Wall Street works, but that is pretty funny. But objectively, the results were pretty bad. Their comps were down 3%, flat for the year. As we've touched on a couple of times, they've got this Polaris strategy, this 3-year strategy to kind of turn around the company. The end of that 3-year period was this quarter. And I went back and looked at how their sales compared to 4 years ago. Answer, flat. And I would say down if you were to adjust for inflation.
Flat, there you go. Flat is the new up at Macy's.
Flat is the new up. So to me, this is the running to stand still strategy. You know, you spend many years, lots of money, try lots of stuff, and you end up in exactly the same place you were before. And then just I'll wrap up really quickly on the earnings front. I mean, Best Buy, comps way down, negative guidance. I mean, a lot of this has to do with how well they did during the depths of the pandemic.
Yeah, lots of buying forward.
Yeah, and so I don't think that's terribly surprising. And then I'll just mention this. We're going to talk about this more in just a few minutes when we get Dan on, is Warby Parker reported, and they've been opening a lot of stores. They're at 200 now. They're going to open another 40 this year. You know, their results were greatly improved. The thing that I looked at, which is not a number that a lot of people pay attention to and is maybe too inside baseball, but, you know, here they are adding all these stores, you know, which are incremental growth. And then, you know, some of their stores are now in their second or third year comp, which generally means pretty positive numbers. But their sales growth is only up 10%. Seems to me like if this were really working, it would be higher. But the other thing was, if you look at gross profit dollars, that was only up just over 7% for the year and just over 5% for the quarter. And since part of the reason why they're not making any money has to do with all this overhead, all the sales and marketing and everything, like that's the number that really needs to start to move if they're going to get to sustainable profit. So I think that's something to really, really focus on going forward. But definitely some nice progress.
Well, a good roundup of current events. Now, speaking of current events, we've got some news coming out of Canada last week. Kind of breaking news, I guess. Breaking news-ish. Nordstrom exits Canada. So big deal on the heels of some bad earnings. They came to Canada in 2014 with what I call a measure twice, cut once. You know, versus Target that said we're going to open 130 stores on May 1. They came in and opened over years a slow roll of stores, which was thought to be a good strategy, you know, figure out the market and then grow. They opened their rack concept stores in 2018, and they join a long list of retailers that have come into Canada.
An esteemed list of failures.
The great hopes, but for a variety of reasons, couldn't make it work. Sam's, Sears, Target, Lowe's, Bed Bath & Beyond, and now Nordstrom. They'll be gone and out of here. E-commerce shut down Friday, and they will be gone in June. So off they go into the yonder. Hanna Andersen. Let's talk about Hanna Andersen. They came up with a resale strategy, and probably the best name I've heard in a long time. What did you think of their strategy?
Well,
their launch?
Yeah, I advocated for including this story, not because Hanna Andersen is a huge brand. I mean, I'm sure plenty of people listening are going like, "Who the heck is that?" Yeah. But they are if you don't know, they are a children's apparel brand. But they are coming out with a new resale marketplace, and the name of it, wait for it, Hand-Me-Downs.
I love that. There we go. There we go.
Yeah. So that's it. I have nothing more to say other than that's just
that's
a great
enough.
name.
You don't need to say anything else. Well, Hand-Me-Downs, love that. Any last thoughts on any news that tickled your fancy, so to speak, this week?
So one last thing that I thought was kind of an interesting tidbit, and I guess this came out of Walmart's earnings announcement. They said that store-filled delivery and fulfillment of e-commerce orders has tripled in just under 2 years. And, you know, this kind of fits with what we've seen from Target and others really leveraging stores to be able to offer that same day, next day delivery. And I think more and more there's this interesting battle that's emerging between Amazon trying to kind of double down on their fast delivery, but struggling to get the top line going there, while Walmart and Target are coming in and saying, well, we actually can leverage our stores in a pretty powerful way. So more to come on this, but I think, this shift is quite dramatic from both Walmart and Target and a few others over the last 2 or 3 years.
Well, all right, let's leave it there. And now, just before we get to our deep dive into .com bomb 2.0 and our special guest, Daniel McCarthy, a few words from our presenting sponsor. There are 2 types of retailers. Those that are committed to transforming at the speed of disruption, those that aren't. If you're a retailer that implements significant changes by intuition, you may soon join the Hall of Shame of executives who bet the farm on initiatives that ultimately failed, so, maybe consider brushing up your resume. But if you are a retailer hungry for a better way to gain useful insights on the impact of your store layout, design, and innovation pilots, you need to know MarketDial. MarketDial is an easy-to-use testing platform that emboldens great decisions, leading to reliable, scalable results. With MarketDial, you can be confident in the outcome of your in-store pilot initiatives before rolling them out across your fleet. Validate your remarkable ideas with MarketDial's in-store testing solution. The proof is in the testing. Learn more at marketdial.com. That's marketdial.com. All right, so our focus for this episode, as we talked about at the beginning, is that you're feeling like we're on the cusp of a retail disruptor meltdown, and we're drawing parallels or similarities to what you and I experienced and saw in the late 90s, wherein the internet bubble burst, like the first .com burst. And let's start into it. Let's jump into that. Now, first, we shouldn't assume that everybody listening is familiar with that period and what happened. I mean, we're not a history lesson, but let's spend a few minutes talking about the buildup in the late 90s, the craziness that happened then, and ultimately the collapse of a very, very popular but very unsustainable business model.
Yeah, well, the essence of it, which is, I think, in many ways similar, is there was this overall belief that e-commerce was going to change everything, and that large businesses could be built by becoming, the Amazon of pet food or the Amazon of whatever, because Amazon was clearly starting to shake things up. So there are lots of businesses that were founded and a lot of venture capital that went into these new disruptive business models, and including some of them that were able to go public. And so this happened quite quickly. And many of these companies got into trouble also quite quickly, so that by the end of the 90s, most of them, Pets.com being one of my favorites, had this high trajectory, advertised on the Super Bowl, and then, or a year later, were out of business. So there was quite a wipeout of quite a lot of companies that were very high profile and kind of came out of nowhere, grew quickly, attracted investment dollars, and then collapsed.
It really, one of the cultural milestones to that period was how many .coms were advertising on the Super Bowl, if you remember, because, the model was like,
kind of like no ETF, right?
It was right. I mean, it happened, this is happening again, right? So it's interesting, similar parallels. I mean, there was remember the concept was land grab, right? There's no limit to the amount of money we can spend, even though it looks totally crazy now because the market is gonna explode. But it was very, very early days in .com, like the late 90s. But that was the prevailing wisdom or thought, or why people were betting on these companies, is that, it's so new that you can spend unlimited amounts of money and it will all pay out and it will all be fine. So that was the vibe. I mean, you like Pets.com, just millions and millions and millions of dollars spent in an acquisition when they couldn't even ship a product. Like, these are even early days in logistics, right? Just these small details.
Yeah, well, I think that's the thing. I mean, I think many of these companies turned out to be, some patterns we can talk about a little bit more are repetitive, but it also was, to your point, very early days. You didn't have nearly the kind of e-commerce penetration that you did today. A lot of the technology, this is a pre-smartphone era, right? So there's no such thing as mobile, really. The cost of processing power, the ability to get third-party fulfillment, none of those things really existed, or if they existed, they were much, much higher cost. So the economics of creating a brand and the economics of fulfilling that demand, even if you could get it, were pretty challenging. But mostly it was just, the market was not developed enough for these to be, billion-dollar plus kinds of businesses.
Okay, so that's a bit of the history lesson. Now, we're not 1999 today. Many, many things have changed. So let's touch on fundamentally what's different about today. So one thing, for example, is, the delivery infrastructure and the experience of people who know how to deliver single units is much broader. There's a broader talent pool. So we should probably touch on a couple of things that are different today before we get back into some of the parallels that remind us of that era.
Well, I think just the main thing from a consumer standpoint is customers, for the most part, are used to using digital technology to find products, learn about products, and transact. To your point, the cost structure, the availability to do certain things like very targeted digital marketing is way more advanced. The cost of data processing is down. You can do a lot of stuff in the cloud, et cetera, et cetera. So I think the fundamentals of what was necessary back then are the same, but the receptivity on the consumers and the technology and infrastructure is definitely well advanced.
So why are we talking about this today? I mean, if we page back just pre-COVID, it was the retail apocalypse, right? Which again was this exuberant narrative talking about physical retail was dead, which was again wrong. What are we talking about today? What are you feeling and seeing? I mean, we talked a little bit about it in the opening when we looked at some of the results, but really hone us in on why we think this is another important moment in the history of retail.
Well, two things. One is, and this is maybe a little bit more beside the point, but I do find it a bit ironic that with all the talk of the physical retail apocalypse, it's even on the table that we're saying, well, actually, if you look at the facts, as we've touched on a few times, so I'll go through this very quickly, it's very clear that e-com's growth has been much higher than sales through physical stores. But in the U.S. anyway, physical stores have had positive growth since 2008. So that's 14 straight years for the U.S. Thousands of stores continue to open every year. And now, in a kind of interesting, ironic twist, many of these disruptor brands that we'll talk about in more detail in a second are turning to brick and mortar as the propellant for their getting to growth. So there's an irony that I just feel compelled to point out. I also, you kind of flagged this early on or a few years ago in my book that I actually think that many of these business models are pretty sketchy. So flash forward now, and the reason why this is kind of gaining momentum from my perspective and is very timely is, many of these companies, whether we're talking about Warby Parker, Stitch Fix, Allbirds, Rent the Runway, et cetera, many of these companies have been around for a dozen years. Many of them have not gotten close to being profitable. And as we're seeing some of the earnings continue to come out, many of them are really continuing to struggle. And so the question is, how many of them are really at risk? What has to happen for them to get on a better trajectory? And what lessons can be taken away for all of retail, but particularly people in the direct-to-consumer space?
When you think about how we got here, is it that businesses, investors, and people didn't learn the right lessons out of the dot-com bomb, so to speak? And you and I sit at a lot of conferences, and I remember the day, right? Here's Warby Parker presenting, and it was an all new way of doing business, and they're going to, so it kind of brightens you up because you're a big advocate of trying new things. I mean, you are very much a fan of you're better off. There's more risk in staying still than moving ahead. So how do you merge these two things? I want to try something different, but I at the same time you want to, the model isn't quite working, but you don't want to inhibit innovation and growth at the same time. We're not talking about that, right?
No. Well, I think first of all, the fundamental idea that new technology and changing consumer preferences can create new business opportunities. I mean, that's always been true, right? It's just become increasingly true as there's a fragmentation of demand and as new technologies emerge and as, like we said earlier, as e-commerce and mobile technology and a lot of these other things just have fundamentally bigger potentials and bigger underlying economics. But I think there are a couple of kind of fundamental flaws in the overall investment thesis. The first fundamental flaw was that e-commerce was going to, take over retail.
Right.
And therefore, that led to this idea that these businesses, number one, could be built to be much bigger than they actually are without any kind of physical store premise, which I'll come back to in a second.
Mm-hmm.
The second issue is that it was pretty easy and inexpensive to build a brand online. And so I think there was a fundamental misunderstanding about how big these businesses could be as sort of a SaaS model, if people are familiar with that, as opposed to more of a traditional omni-channel kind of business. And that, you could create these great brands. And one of the things that really got a number of businesses confused in the early days was how quickly they went from, no sales to $50 or $100 million in sales. And they did that largely through word of mouth and very cheap cost of customer acquisition. And we're going to talk more about cost of customer acquisition with Dan in a few minutes. So, but I think there was just this business model, the underlying investment thesis was pretty flawed. And so that led them to think that the total addressable market was much bigger than it's turned out to be. The cost of getting these businesses beyond $50 or $100 million from a marketing standpoint turned out to be quite expensive. And then, which we also touch on a little bit later, Apple changed their privacy, the cookieless thing, and just in general, every brand was moving to much more performance-oriented marketing. The cost of marketing has grown, probably 10 times from where it was 4 or 5 years ago.
And it's hard, as one of our guests has said and continues to say, Scott Galloway, it's like it's hard to win in the Meta or Facebook or Google world today the way you used to, because it's almost like a utility now. It's almost like a cost of doing business, and you've got to do it. It used to be you could develop some expertise at it and be miles ahead of anyone else.
Yeah.
The differentiator has become the table stakes. You just got to be good at these things, but it's hard to gain advantage. Therefore, it's hard to, and Dan talks about this, it's hard to get a lower cost of customer acquisition because everybody's kind of paying, everybody's doing it now, right?
Yeah, and I think there were two walls that got hit, one of which relates to that, which is, it's one thing, it kind of gets back to what I was saying about kind of the early success that many of these brands had. It's one thing to kind of quickly sort out the perfect fit customer, the ones that basically find you and are likely to stick and you probably don't have to promote as heavily. But there's a point at which, and I think every one of these brands pretty much has hit to varying degrees, where you've got to go find customers.
Yeah.
And you've got to actually steal away pretty good customers from other brands. So, if you're Bonobos, maybe you find that quick $40 or $50 million, which is nothing in the scheme of things, among customers that are not really happy with their choices, love to shop online, are willing to pay a premium price. There's that perfect fit center of the bullseye customer. But then at a certain point, you're basically going after the Nordstrom customer, right? And maybe, most of those customers like it pretty well, but also Nordstrom's pretty good at bidding up keywords to get in front of those customers. And so you have this dilemma of paying more and more to basically bribe those customers to try you. And chances are the customers you're going after at a certain point, whether that is, 75 million, 150 million, are not as inherently valuable, which is what we'll touch on with Dan in a second. The second thing was just really this idea that online shopping was not going to take over the world. It turns out, whether we're talking about Warby Parker or Wayfair or Bonobos, there are a lot of customers that really want to touch and feel and see the product in person. As their growth flattened out, again, this idea that you could build these huge brands online only, that turned out not to be the case. You needed a physical presence. So now the second kind of hurdle to overcome, and we'll see how well this works out because it's still early days, is that brick and mortar expansion was necessary to grow. And now that's a whole different animal in terms of capital investment, in terms of what it takes to manage this, like we got into with our interview with Nish from Leap. So a lot of the fundamental issues here were not really anticipated. And so we're seeing many of these brands really hit a wall. And you can pretty much go through the list. There's a few exceptions, which maybe we can talk about. But if you go down the list of the highest profile digitally native vertical brands or new DTC brands, most of them have seen their valuations, at least the ones that are public, down 70, 80, 90% in the last year. So that's something that really makes this even a more urgent conversation.
We talk about these very visible companies that are operating in this model. The ones that intrigue me, and we got into this with our guest Simeon Siegel, is all the brands, consumer brands, that decided they were going to go direct to customer and just bypass retail. Remember, that was the late thing in the late 90s, the disintermediation of retail. Well, it just didn't work because you change one set of costs for another. But, it's expensive to ship a pack of toothpaste to a home directly as Crest or as Procter & Gamble. Like initially, that was the enthusiasm as well, right? Retail was useless now. I guess my last comment was, I reflect on what you're saying, it really gets back to what we talked about buying versus shopping, right? If your assumption is everybody wants something very efficiently to the doorstep and never wants to shop and has no interest in shopping and just ticks a box on a list, .com is wonderful. But we know, and I think it's one of the fundamental mistakes many people assume, is many people want more out of shopping. It's cultural, it's social, right? I think that, for me, brings this all together.
Yeah, I think that was a fundamental misread. The other thing I would say quickly before we bring Dan on is one of the, direct to consumer, as you well know, it's a pretty old business model in a lot of respects. Mail order catalog companies pioneered the space. And so one of the things we know about what makes for a good direct to consumer business, and we know this from the direct marketing days of mail order catalog, is you've really got to be able to manage your outbound marketing costs against your total average order value. Because, it basically costs the same to pick an order, pack the order, and send it through the mail. Some more differences on the postage side. So there's certain kinds of businesses that, regardless of whether we're talking, new age businesses or old school businesses, that lend themselves to being good direct to consumer businesses, independent of having a brick and mortar footprint. So when we look at some of the winners and losers or companies that are challenged, if you have infrequent purchases like you do with Casper and Wayfair, it's a lot harder to leverage that expensive acquisition cost and make money, right? If you have a business that has very expensive shipment cost, like furniture, it's very hard to get the unit economics to work. On the other hand, if you're a company like, for example, On Running, which is a newer company, it's fairly inexpensive to ship a pair of shoes. They have pretty good gross margin to begin with, so that gets your order value up. Serious runners buy multiple pairs of shoes every year. So even though you're fairly focused, you can get good repetitive sales. Or another business that's done quite well, started around the same age, is Hims and Hers, the sexual wellness brand. Very, it's a subscription base. So you get, if you can get the retention, you get a reliable course of revenue. You don't have to keep spending a ton to acquire customers over and over again. And it comes in a tiny little box. It costs nothing to ship, and it's got relatively high average order value. So there's some of these things, and I guess that's maybe the last comment I'll make about what people got wrong. I think a lot of the investors and the entrepreneurs acted as if these new DTC type brands were plowing totally new ground, and they weren't. There's some underlying economics of a good direct-to-consumer business that we've known for a long time. And one of the reasons why I've been negative on many of these companies is they didn't seem to get that.
Well, we've had our great discussion, and we've referred to some of these metrics in this business model before. Dan's been on the podcast before. Let's hear from him today. Daniel, welcome back to the Remarkable Retail Podcast, my friend. How are you?
I am doing well. It's great to be back.
This is your second appearance on the podcast. You were very, very popular, so we had to have you back on because, of course, we need another popular episode. Kidding. We know.
Gotta drive traffic.
Got to drive traffic. You are the best. You're not clickbait, but you're very popular with our audience, and your insights are so valuable. So when we were thinking about what we were going to talk about today, Steve and I, we thought only one name came to mind, and it was yours. So thanks.
And that person wasn't available, so we wanted to.
I'm glad to be number two. But
well, you're number one in our hearts. Listen. Let's assume not everybody's heard our first interview with you, and or may not know about you. So tell us a little bit about who you are and what you do for a living.
Yeah, I'm kind of wear a couple hats. One hat is as an assistant professor of marketing, and so I spend a lot of my time writing academic papers and teaching about customer lifetime value and how to be able to predict it well. So you got a customer base, you got some transactional data. We want to know who's going to be doing what, when, and for how much. And then we also want to know how that kind of drives overall valuation and health at the company level. So you take companies like Wayfair, like Warby Parker, they've got a customer base and they've released some data, and we want to be able to take that and be able to say, this business is healthy and this business is not. And so, the kind of the way I'll go about it is by predicting customer adoption, retention, repeat purchase and spend, and contribution margin. Tee that up with an understanding of how much companies are spending to acquire customers in the first place, and then using that to drive estimates of overall valuation of what revenue is going to be in the next bunch of quarters, or even just kind of more narrowly, what is customer lifetime value, and how has that been evolving over time? And so they call it customer-based corporate valuation, written a few papers about it. So yes, that's kind of hat number one. Hat number two is kind of moving away from the ivory tower and just doing this stuff for real. So I'm also an entrepreneur. With my advisor, Wharton marketing professor, Peter Fader, we've now started not one, but two companies. So the first company, did all this sort of modeling. Oftentimes it was for direct-to-consumer disruptor type brands, typically on behalf of the marketing departments at those companies. One of our clients was Nike, and so we kind of grew the company and sold it to Nike, and we're able to kind of carve into the non-compete that we could start a second company that kind of focuses more purely on this concept of customer-based corporate valuation. So between those two companies, we've probably brought this model, the sort of models that we'll be talking about, to life on maybe 350 or 400 companies. So if you have some perspective, just actually seeing this stuff in action across a broad swath of the sort of categories that we'll be focusing on.
It's a great mix of the academic rigor and science, if I can put it that way, and the practical and hands-on. Who typically is you mentioned some companies that would hire you to understand that. I imagine there's lots of other people trying to value businesses who reach out to you and say, I remember what we said after we talked to you is like, how else would you value these companies? Like, it seems so straightforward, but it's not that common, right? So people want a deeper look into the numbers, yeah?
Yeah, so Theta is the new company. We kind of have two broad customer groups right now. One is private equity, and then the other is the companies themselves. So we had that non-compete, but the non-compete expired. So we've got the ability to kind of go back in and do the tactical marketing stuff again. But you're absolutely right. I think on the private equity side, they understand that it's important. Like they've done all this work. Typically, they're ignoring the customer. If they are kind of incorporating customer-related measures, they're usually taking whatever the company has provided them at face value. What can often happen is they'll kind of get to the final stage of the diligence process, and the target company plunks the whole transaction log into the data room. And they just kind of look at it, they stare at it, they're like, seems like that could be valuable, but I don't know what the hell to do with it in a week, in 2 weeks or however it is, long before they have to put in their bid. And so what we'll do is we'll kind of go in and do a sprint to kind of take that information, take that data and convert it into useful insight about unit economics.
So that's great to kind of give us this high level approach. Maybe we can now dig into a few specific examples. So Wayfair, as we talked about in the intro to this segment, reported, I think what, at least from my perspective, was pretty much a train wreck of a quarter. Their sales were down a lot. They lost 5 million active customers, had a pretty sizable operating loss, I think, by any stretch of the imagination. But do you agree it was a problematic quarter? And then in particular, what are you looking at to try to understand whether this business can get on a positive trajectory or is really significantly underwater?
Yeah, Wayfair is a great example, I think, how this approach can be valuable. That you have a lot of companies that are growing quickly and losing money. And, we're not going to say that every company that loses money is a bad company. It could be that they're able to grow their way into profitability. But to be able to do that, what you need is operating leverage. That growth is going to bring about better margins. And And really, that is what customer lifetime value analysis is intended to do. It's to say, when you acquire that next customer, are you making a bunch of money or not? And if you're making a bunch of money kind of on the margin, then even if you have a whole bunch of overhead that's kind of encumbering overall profitability now, well, if you acquire a bunch more customers, you will be profitable in the future. And so at Wayfair, I think the tough part is they've done a great job of growing, but they have not done so with good customer lifetime value, with good economics. And they've kind of secondarily been hit, especially over the past couple years, with this real whiplash that's kind of been driven by COVID. That they had a really sharp increase in revenue that was spurred on by COVID shutting down all the furniture stores at a time when furniture stores represented something like 85% of all furniture purchases in America. And so it just created this humongous windfall, increase in demand. And even Amazon, which was kind of one of the big digital competitors to Wayfair, they were prioritizing other categories. And so even other, furniture e-retailers weren't in the game anymore. So fast forward to today, what we've now been observing, and I actually wrote a whole academic paper on this, is a lot of the increase in demand that they saw. Obviously, the share expansion that they got, that they got to keep. But what's been happening now is all of those furniture stores are open again, and at the same time, a lot of the demand for the category was pulled forward demand. That everyone did their home remodeling, they bought that desk for their work from home office, and they don't need to buy another desk anymore. And so in the same way that we perhaps were overshooting the baseline, kind of what we would have expected demand to be in the absence of COVID, now we're kind of undershooting that baseline. And so they're kind of getting hit on a number of different fronts at the same time. I guess the other front that's been hurting them is the privacy related changes. So one thing that we've been observing is that their CAC has just been their customer acquisition cost has been going through the roof. There's been debate about how exactly we should calculate their CAC, what the CACulations should be. Sorry.
Oh, wow.
I like
terrible,
that.
cheesy CLV jokes.
Hashtag.
Yeah,
calculation.
PhD in that. The most recent figures, again, these are all illustrative, but they say, 7% of our repeat sales is what we're spending on ad spending to generate that revenue. And so if you kind of back that out, the amount that they're spending to initially acquire customers has gone from something like $40 to upwards of $110. So It's just gotten a lot more expensive. A big question now is this just, the unwind of COVID and, we'll kind of be back to $40 once this has kind of worked itself through. And part of me believes that a bunch of this is secular, that they just are not able to target as well because of the Apple changes and because this is a category where, there is a relatively longer customer acquisition funnel. And so the benefit of being able to target the same person again is higher here than it would be for a category where, you get hit with the Facebook ad and either you buy or you just don't buy. So the fact that something like, I think they said in the last quarter, 60% of their revenue is coming through mobile. I think that's exactly the sort of thing that will lead this to be a bigger issue for them than perhaps for another digital disruptor.
Can I ask you more? And this comes more from intuition because I think I was and I maybe am overly burdened or my view is masked by having worked in the furniture business years ago and knowing some of the challenges, particularly on the logistics side, which I know is not your area of expertise. But one of the things that struck me about many of these brands, not just Wayfair, was that a lot of what seemed to be causing them to gain market share was very, very low pricing relative to typical competitors and really, really heavy marketing. And I'm wondering, you obviously are getting down more to some specific things, but just as a general, I guess, guidance in terms of people looking at these companies, can you really parse out how much of the underlying economics are related to just uneconomic pricing as well as just greatly exaggerated marketing expense, even beyond just the everything you pointed out about cost of customer acquisition?
Yeah, well, certainly a lot of the marketing spend, that translates into a high cost of customer acquisition. I think to your point, it also translates into a lot of marketing expense for repeat purchases, and that's a real issue. I think that in general, the magic of CLV is that the initial acquisition is expensive. Once you brought them in the door, that the repeat purchases are cheaper. That you just don't have to market as much to get a repeat order as you did for the initial order, and that no longer becomes the case. It becomes much less the case if the company is spending up the wazoo on repeat orders too. And so, so that operating leverage, it doesn't quite swing to the positive, and I think that's also why here we are. I think Wayfair gets something like 80% of its orders from repeat customers. And so you think, well, shouldn't we have seen that operating leverage by now? And yet we haven't. I think to the former point about the pricing, that I don't, I haven't done the web scraping analysis of looking across different companies selling the same product, but certainly the margin profile is also quite compressed when we move away from the marketing spend. I think that their gross margin, it used to be around 20, call it 25%. Now it's up around 29%. But when you factor in, customer support, merchant processing fees, other variable overhead, and then, the ad spending for the repeat orders, the contribution margin is in kind of the lowish teens. And so, it's just hard you have to bring in a lot of revenue dollars to hurdle over the CAC when your contribution margin is that low.
Well, Steve, by the way, I think we have a new title, Up the Wazoo. That's a new title for the episode. Dan,
technical term.
A technical term. Dan, let's pull the lens back a little bit. I mean, there's a whole host of companies who would have challenges around the privacy. That's not unique to any one company. And as well, a lot of companies who've seen products bought forward. I was talking to some retailers this week. I said, listen, there's no demand. People don't need another TV or another treadmill. They already bought one. Any general lessons that you can impart, kind of a parting words on our audience around how to best put into play these principles as an operator and make the better decisions that need to be made probably for this year and years to come?
You always say, step one is just to know what your numbers are. You'd be surprised how many companies just don't know their numbers. And it's not trivial to get them. It's not that hard, but it's not like you just kind of snap your fingers and they magically appear. You really need the right data. You need the right definitions for the measures, and then you need the right models to be able to predict customer behavior and see how it all rolls up. So it's good to know, that this is kind of where we are in terms of payback periods. What is our contribution margin? How has our CAC been evolving over time and across our different channels? What is the customer lifetime value, and how has that been evolving, over time and across channels? And I think that can help you understand where the heat in your business is coming from, and how it all kind of rolls up when you look at just how it rolls up at the overall company level. Are we healthy from a unit economic standpoint? And as our marketing budget evolves and as the customers that we acquire, as that composition, as the mix of the customers changes in directions that we would kind of expect it to, like moving more towards paid channels, will we continue to have good economics, for our future cohorts? So, I think that's the sort of thing that has been somewhat surprisingly lacking. Even I think for companies like Wayfair, at least based on the public disclosures that they've provided. I think once you have that in place, then hopefully that will kind of beg the next set of questions like, wow, this is doing really well, or wow, this part of our business is really not healthy. What should we do about that? And but I think that step number one is kind of the important first one.
So as we move to closing here, I'm curious whether you've got any, whether we call them disruptor brands, new DTC, whatever, but are there particular retail brands that you look at and say, wow, here's a company that's really done it right, or here's a company that some of our audience might really learn from taking a look at their strategy, or, at the same time, other companies that you're just, wow, really, really concerned about? Any kind of short list of companies that you find particularly interesting and instructive?
Yeah, I think a couple examples that could be interesting. One, I know we had spoken about, I think, Warby Parker on the last podcast, and I think that they've been holding up a bit better. We had said that they were overvalued as of their direct public offering, but
good call.
Come down a lot. Yeah, we put out this other analysis when they started to trade down to 11. Where he said if that original analysis was even kind of directionally correct, there could be room for upside. And thankfully it kind of moved back into our valuation range on the upside. So we've been more constructive on them because their economics have been better. I think they're still a bit bloated in terms of overhead, but the customers, they keep coming back. So I think that there's real indications of good product market fit from that standpoint. I'd say the other kind of thing that I've been following is just kind of the overall plumbing, like the ecosystem that kind of underlies all of these businesses. And I think one thing that could be good to have on the radar screen are companies like Pipe that will basically treat the customer as a securable asset that can be lent against. So it's this growing kind of ecosystem of revenue-based financing. If you've got a good customer identifier, companies, they don't want to have to raise equity if they can avoid it. So effectively, they can kind of sell the revenue from those customer contracts in exchange for a loan. And to the extent that we've got a whole bunch of old cohorts that can give us a really good sense of the repayment profile of those customers, I think everyone can potentially win. So it's a space that's been growing. I think that they tend to be very short-term loans. So it's just kind of, I think something to just keep an eye on.
Super interesting conversation. I feel like we could go for hours here just trying to unpack some of these trends and all your knowledge about them. But it's great to get you back on the mic with us, and we're going to stay on top of all the work that you are putting out there in the world. But thanks for joining us on the Remarkable Retail Podcast.
Yeah, thanks for having me.
Well, as always, Dan delivers. He drops the knowledge, man. I mean, his approach. It's funny. I said to it in that interview, and you and I both said in the last one, how else to look at some of these numbers? But it really does anchor our dialogue in this cost of customer acquisition, and Dan puts an exclamation point on how important that is. All right, so now we've talked about some of the challenges. We've talked about some of the winners, who's doing things right, the My Teresas of the world. As you look forward, we're here in the spring, early spring of 2023. We've talked about the tide going out. That was one of our principal understandings of this season. What are you thinking for the future? And the future, let's just cast our minds ahead to this calendar year and shortly beyond. What's your prospects for success, and what do you think is going to be different?
Three things to focus on. One is very much what Dan was talking about, is as we get more data on these companies in subsequent quarters, do we see these underlying dynamics move in a positive direction? And clearly, when you look at a Wayfair and a few of these other brands, their current numbers don't look so good. So do we start to see them really address those underlying issues? And if they don't, that's very, very problematic. I think the second thing broadly is, it comes back to balance sheets for some of these companies. It seems the case that they're not going to get a lot of help from the economy. And it's a very difficult, at least at the moment, I don't see any reason it's going to change very quickly. It's a very difficult funding environment. So if these companies start to run short on cash, they're not likely to be able to raise money at favorable rates or under favorable circumstances, which I think, and part of my prediction is, you see some of these brands get acquired because they just can't get there from here. And then the third thing, and I still think we're in early days, except with maybe Warby Parker, going back to the comment that it's ironic that so many of these brands are really setting their fortunes and their prospects on physical stores. How well are these companies able to profitably expand? I just think with most of them, they haven't opened enough stores or had them open long enough to really know whether they've got a lot of upside there or it's pretty limited, in terms of number of locations.
It's an interesting point because Warby's been, this is not a new concept, but just take Warby Parker. They've had stores for, better part of almost a decade, you think the model would be either proved or disproved at this point. But it seems to be we need more stores to continue to prove the model out or to evolve to where we are. Is that what you're thinking, or is that what you're keeping a close eye on?
Warby Parker claims, on the one hand, they seem to be suggesting the stores are not quite as performing as well as they would expect, but they generally say that the model is working and they're confident that they can expand. This may be, one of the things I wonder about with all these businesses, it's one thing to open 10, 50, 100 stores. It's another thing to get to 900, like Warby Parker says. And there's plenty of brands, Coach being a good example, Michael Kors, that way overshot the runway on their store expansion. So I would think by now Warby Parker has a pretty good idea of that. Most of the other companies that have way under 100 locations, just like Casper talked about, I think opening 800 stores when they had only opened like 15. And, that turned out to be just impossible. So I think, paying more attention, particularly as we get into next year, on what we're learning from this store expansion from these brands, I think that's really going to be a telltale sign.
All right. Well, fascinating discussion, and more to come, basically, as we kind of continue to watch and see how it evolves over the course of the year. Let's leave it there. Great episode, and we'll talk about it more, I'm sure, on episodes to follow. If you like what you heard, please follow us on Apple, Spotify, your favorite podcast platform, so you can catch up with all our great interviews, including Organized for Growth, our interview with Satish Malhotra, CEO of The Container Store. New episodes of Season 6 presented for another season by our friends at Marketile will show up each and every Tuesday. And be sure and tell all your friends and colleagues in the retail industry all about us.
And I'm Steve Dennis, author of the best-selling book, Remarkable Retail, How to Win and Keep Customers in the Age of Disruption. You can learn more about me, my consulting, and keynote speaking at stephenpdennis.com.
And I'm Michael LeBlanc, consumer retail growth consultant, keynote speaker and producer, and host of a series of retail trade podcasts, including this one. You can learn even more about me on LinkedIn, and you can catch up with Steve and I in person at Shop Talk in Vegas, March 26th, and a month later in Barcelona at the World Retail Congress, April 25th. Until then, safe travels, everyone.